Good afternoon, everyone, and welcome to the first session of the 2021 Foremost Real Estate Investment Series, or FREIS. For those who don't know me, I'm Ricky Dogan, Head of Investments at Foremost, and I want to thank you for taking time out of your increasingly busy schedule to join us today. We are planning 4 amazing and insightful webinars for FREIS spread throughout the year, so please stay tuned as we announce future dates and guests. If you have anyone you would like to hear from or topics you would like touched on, please do let us know. I want to pass things off quickly to Evan because I really am so excited for today's guest. But before I do that, I want to remind you of the real reason why we are all here today. FREIS is in support of Face the Future Foundation, a truly amazing not-for-profit organization that raises money to fly North America's top head and neck surgeons to the developing world, where they provide life-saving and life-changing surgeries. This charity is so phenomenally efficient and lean that each dollar donated buys $45 in equivalent healthcare services. To date, FREIS has raised in excess of $20,000 for this incredible foundation, which unbelievably translates into almost $1 million in medical services. Face the Future's founder, Dr. Peter Adamson, asked me to pass on his heartfelt appreciation and to let you know that your donations are making a real difference in their ability to mount these amazing surgical missions. He writes that today, more than ever, we appreciate that we live in a global health village, and the impact that we can have is tremendous. I will paste the donation link in the chat, and I ask that if you enjoy today's session, that you do make a donation. Honestly, no amount is too small. Our sponsors really stepped up to the plate this year and have helped us already smash last year's donations, and we really can't thank them enough. The platinum sponsor for this year's FREIS series is MBC Managed IT Solutions. MBC is an award-winning security-first managed IT services provider. Since 2000, MBC has been helping Canadian businesses grow by handling their corporate technology needs through cloud solutions and managed IT services. MBC's clients are very unique, operating in different verticals. However, what they share among them is the desire for IT to be simple, secure, and modern. For its constant efforts to improve its clients' IT, MBC has earned multiple awards, including Excellence Canada for customer delight, engaged employees, innovation, and sustainable financial results. They've also been named one of the top 50 Canadian managed services providers by Cloud Tango for the 2nd year in a row. The presenting sponsor for today's webinar is Equitable Bank. Equitable has grown from a small trust company into Canada's 9th largest Schedule I bank and has embraced technology and innovation to truly position themselves as Canada's challenger bank. They offer a range of products, including an array of fantastic borrowing, saving, and investment solutions. We would like to again thank all our amazing sponsors who have donated directly to Face the Future. A warm and hearty thank you to MBC and Equitable Bank, as well as Ernst & Young, HSBC, and Evans Investment Counsel. All right, so now on to the show. If you have read any articles or watched any news stories on GTA real estate lately, chances are you have heard some of his amazing insights and analysis. John Pasalis is the president of Realosophy Realty, a Toronto-based real estate brokerage that uses an analytical approach to uncover hidden trends in the GTA housing market, and a pioneer in the reporting of real estate statistics at the micro neighborhood level. You can find links to the Realosophy website and to his awesome blog, Move Smartly, in the chat, and I encourage you to check them both out after the discussion. John is currently working on his doctorate in business administration at U of T and Henley Business School, UK. His research has been shared with the IMF and cited by the Bank of Canada and CMHC. I'm personally a big fan, so honestly, I could probably go on for a while, but without further ado, I would like to welcome our CEO, Evan Cooperman, along with John Pasalis. Also, please note that you may need to click on your screen to change the view so that you can see their video feeds. I hope you enjoy.
Okay, thanks, Ricky. Just before we get started with John, I really want to just take a second to recognize Ricky because he's taken ownership of FREIS And you can see that as soon as you move me out of something and you move somebody who knows what they're doing, our fundraising is already higher than it's ever been. So thanks to our sponsors and also thanks to Ricky, because you're doing a great job. So John, thanks so much for joining us today. In prepping for this, I've been getting more and more excited as I've read more and more of your stuff. I think you've got some strong opinions, which I love, and I'm excited for you to share them with our group here. So let's get right into things. I think you started Realosophy in 2007, and there's a real vision there. So do you want to maybe just tell us a bit about the company?
Yeah, for sure. I mean, I'll start by saying thank you for having me. It's pretty exciting to having these discussions. I think we're living in an interesting time in the housing market, so it's always good to try to make sense of what's going on. In terms of our company, yeah, I started our company in 2007. I mean, the idea was always to basically, take a little bit more of an analytical approach when it comes to residential real estate. I mean, I always found that was a big gap in the business. I started in commercial and multi-unit residential, like my family was in that business. So I kind of started there and just had a stats background, had a data background and a tech background. So I just wanted to kind of merge technology, information, data analysis into sort of the residential side of the business.
So look, foremost, we spent quite a bit of time thinking about data, and what kind of decisions can be informed, by having access to good data. Can you maybe share with us what are some of the insights that you've been able to glean from the analysis of the data, and how's that helped make better decisions?
Yeah, okay, so there's two ways we use data primarily. I mean, one is at a very micro level to basically try to uncover, I'll say, like hidden issues with homes. So we take like a very big data approach. We pull data from a lot of different sources to really highlight potential problems with houses that aren't disclosed. So this is from, City of Toronto's open data platform, freedom of information requests, these types of things. So that's kind of what we do at a micro level. At a broader level, I do a lot of analysis of the housing market, and trying to kind of uncover sort of what I'll call like micro trends in the market. A lot of economic analysis about housing markets tends to be at the macro level, what's going on in the GTA. I tend to focus a little bit more granularly in trying to understand how things are moving differently across the GTA by region and by house type. And I think that's kind of gives us a lot more insight into sort of some of the divergent trends that might be going on in the housing market. We saw a big bubble in 2016, 2017. And that's kind of what led us to do some research into that, to understand this wasn't a GTA bubble, it was a suburban housing bubble. So those are some of the things that we do.
Okay, so we're gonna get into the data, because I really want to talk about the whole bubble thing. But just before we do, maybe a little bit more about the PhD that you're doing, and how did that happen?
So, I mean, a complete fluke. I mean, I was doing some research. I went to my old econometrics prof at U of T and I said, listen, I need some help with this stuff. It's a bit over my head. And he basically said, well, why don't you do this, enroll in this program? And it's kind of like the PhD version of the executive MBA. So it's basically like a PhD for business people. It's like 5 years. You basically are just doing research and are publishing a thesis. And it's really just an extension of what I'm doing. It's taking a different approach to analyzing housing data to kind of try to better understand, again, like a lot of housing analysis is at the macro level, which is kind of, it would be like trying to understand the equities market if you only look at the indexes without looking at the underlying stocks that make them up, right? So I try to look at the equivalent of the underlying stocks, which are the, different house types, different regions, different neighborhoods, and sort of try to roll those up to get a bigger picture. So it's generally an extension of what I do sort of in our business. I'm just doing a little bit more academic research around it in a more structured way.
Okay, and so I guess just to give you a plug, somebody would want to work with your firm because they will make a better informed buying or buying decision because they're going to have that micro data.
Yeah, I mean, generally, again, when it comes to houses, we're going to tell them a lot more information about houses that's not on the MLS is sort of one example. And then, yeah, at a sort of, when we look at the economics and the analysis, like a lot of times we're not worried about things sort of day to day, but we are worried about turning points in the market. And that is something that we look at and caution our clients. When we saw the market turning in 2017, we're probably one of the few brokers who told people like, maybe wait right now because things aren't looking good. It's advice like that we try to focus on.
Okay. And so one more, and then we'll move on to
Sure.
your market insights. There was a battle to get access to data, right? Because Treb controlled the data. And, so I guess, were you involved in that battle, and where do you see, what's the next step? What's the next step in that data collection?
Yeah, so I was a witness for the Competition Bureau. So we were fighting for more open access to data. They ended up winning that battle. And the order from the Competition Tribunal was basically that the real estate board has to give sold data to brokerages, and we can display them on our website. So the data is not technically open. It's only available through real estate brokerages. If a home buyer or a seller wants to view sold prices, they have to log into our website or another brokerage's website. But that's, way ahead of where we were, 10 years ago.
And where would you like it to get to? I guess just
personally, I think that's a very big step forward. I actually don't think it's going to go any further. Like there's no chance it's going to be open, because the data is controlled by the real estate board. If you look at what's going on in the US, which is usually 10 to 15 years ahead of us, it's the same model that we have right now, which is basically the data's managed and controlled by real estate brokerages and agents through the Toronto Real Estate Board.
Okay. All right, thanks. So let's move on to what people I think really want to hear, which is where we are in the markets today. So I spent some time on movesmartly.com, which is your blog, which I highly recommend people check out, because you actually post content that's easy to digest, and your videos are great. And I want to just, before we start throwing around the B word, bubble, maybe you can help define what that means to you. Like, what is a bubble?
Yeah, that's a great question, and I get it a lot. So, if you look at sort of the literature and a lot of the research into housing markets, there's usually like two ingredients to housing bubble. The first is that house prices are high relative to fundamentals, which is, usually comparing house prices to incomes and rents. And I think this trips up most people because, a lot of economists will see that house prices are high and they'll make that argument and they'll assume it's a bubble. And that's generally not the only requirement. House prices can stay elevated in a city for a very long time. It doesn't mean it's a bubble. If house prices appear high, but they're only appreciating at 2% per year, that doesn't look like a bubble. So the other ingredient usually is that the growth in house prices seems irrational, right? And it's driven by what economists call like behavioral factors, this over optimism, this fear of missing out, this assumption that house prices are going to keep going up 10 to 15% per year. And that's generally sort of the two main ones. More recently, when we think about how house prices are changing, so a lot of economists, like if you look at sort of how house prices have changed in the GTA across 20 years, prices have gone up, but the rate of growth is actually pretty stationary. Like say the average percentage change in house prices is 6%. It's stationary because, one month we might be up 10% or up 3%. The rate of growth is kind of within a narrow band, right? But when the rate of growth starts surging way above that, and you start going from 6% growth to 10 to 15 to 18 to 20 to 25 to 27, it just keeps going higher to the point now where in a lot of the GTA, you're at 30, 35% year over year growth. Well, that is like an explosive change in the rate of growth of house prices. That's like another symptom that a lot of economists look at to sort of define a bubble.
Right. Okay, thanks. So just to prove your street cred,
okay.
In 2016, I should just point out for everybody that you did at that point in time call the last peak.
Yeah.
So maybe can you explain what you were seeing back then, and what you said back then?
So yeah, so our 2017, actually, I wrote a report, and it was really just driven by, the one thing I like about our business is we see everything that's going on the ground first. And for me, it's like, those are the clues into sort of the irrationality we talk about. And in 2016, we started seeing way more people coming into our office saying, I just want to buy an investment property. And we were like, okay, you want to buy a condo? You want to buy a triplex? Like, no, I want to buy a detached house in Markham, and just rent it out. And, when we work the math with them, they'd be spending 1.2, 1.3 million, and they'd be making, $2,600 a month, and like those numbers don't work for anybody. Like it's not, and we walk them through the numbers. They listen, you'd be losing $1,000 a month or $1,300 a month because your rent's not going to cover your expenses. They only wanted to put 20% down. And everyone's answer is the same. It's like, I don't care. Doesn't matter. Because in a year, the $1.3 million house is going to be worth 1.5, and in 2 years, it's going to be 1.7. So, you know, to me, this is not rational. Like most investors I know don't buy income properties and are bleeding thousands of dollars a month because their rent won't cover their expenses. So I basically ended up kind of researching to see if this phenomenon was happening, again, taking like a micro approach. And we basically just looked at how many homes were being bought by investors who were renting them out immediately after they took possession. And when we did this, we found that it was actually a huge percentage, and it had been growing over 5 years. And in areas like Richmond Hill and in Newmarket, it was something like 25%, and in some cases 30% of the homes that were being bought were actually being bought by investors. You know, and then again, this is like another classic sign of a housing bubble. Like the more people are buying homes strictly as an investment and they don't care about their cash flow, they don't care about their rent, it's a massive red flag. So we published reports that this is what's happening. And I mean, I don't want to say I called it the peak. I mean, I kind of released it around the peak. You can't really predict when prices are going to fall. But it was just coincidence. I think I released it in March 2017, and literally like a month later, prices tanked, right? And coincidentally, I mean, not coincidentally, the Bank of Canada took our data basically and then mapped all of the areas that we highlighted had the highest ratio of percentage of investors. And basically a year later in their financial system review, they basically showed that those areas had the most significant decline in house prices. And the areas that, like, say, had no investors didn't actually decline at all, or not very much. So there's this tight relationship between investor demand and the change in house prices.
Right. Okay. So just to reiterate for everybody on the call, I guess, you know, I like to think of things in terms of fundamentals, right? So you can either buy on fundamentals or you do your analysis. So in the case of the house, you want to buy a stream of income, and you're not going to want to buy something that's negative cash flow. Mm-hmm. Or you're a momentum player where you're just riding the wave, right? Mm-hmm. And then, but then you're exposing yourself to Buffett's old saying, right, that you only know who's swimming naked when the tide goes out.
Exactly, 100%.
So let's find out who's swimming naked now. Yeah. In our current environment, you said in November of last year, you said things were, quote, bubble-like.
Yeah.
So how have things changed since then? And, where do you think we are now?
Yeah, so when I wrote that, again, this was driven by what we were seeing on the ground, right? And kind of before the data made it kind of obvious. And what we were like in a normal market, you'll have a lot of, obviously Toronto's very competitive. You have tons of bidding wars and, people kind of push the prices up a little bit, but they're usually, most homes sell within a reasonable value range. Like, forget the fact that they sell over asking. That's just like a marketing gimmick. When you actually do a valuation of the property, they're usually within a reasonable range. But periodically you get one person who just doesn't care and pays like 5 or 10% more than the property's worth, right? And in a normal market, every other buyer, when they see that price, they think to themselves, well, that person was crazy. I don't know what they were thinking, but every other comparable for the house that I want to bid on says this house is worth X. That's what I'm bidding. They kind of dismiss the outlier, right? But what was happening in November and December was that these outliers were not just outliers. Like, more and more people started chasing them, right? So what happens is if in 2 weeks, home buyers are paying 5% more than what the same house sold for 2 weeks ago, well, all of a sudden house prices are going to be rising really, really rapidly. And that's exactly what happened. Literally between like December and January, in 2 months, house prices went up 16%, which is like, it's irrational. Like, house prices don't go up that much, during that period. It was basically like 8% per month. And that was just because of, again, this behavioral dynamic where buyers, like, there's so many bids on houses, like 40 bids, 50 bids, and people just felt like, to win, I've got to pay 50 grand more than what the same house sold for last week. And to me, that's kind of, again, one of the symptoms of a bubble. And that's basically where we are today.
Right. Okay. And I guess also, just to frame things for people, I mean, we've done our own analysis of where we think normal house price appreciation should be. And I think you mentioned it a little bit. What's your opinion on kind of baseline healthy home price appreciation?
I think like historically in the GTA, it's probably close to like 7%, and some periods it's 10 to 12, and some periods it's 2 or 3, depending on mortgage policy and changes. But I'd say something like that has been pretty much the norm.
Okay. All right. So by any measure now, we're quite a few, probably, I don't know how many standard deviations away, but we're far from the
Over
norm.
3, yeah, over 3, yeah.
Okay. So that's I don't know what that is in stats terms. It's more than once in 100-year type move. Okay. So I'd like to get into implications of this and what you see, but before we do that, you know, I joke at the AGM that I have a very small brain. Maybe it's actually true, it's not a joke. So we like to think of things in very simple terms. Okay, so we go back to Econ 101 and we talk about supply and demand. We talked a lot. Our investors will know how we feel about constrained supply and you know, outdated zoning bylaws. And for a bunch of reasons, supply is very constrained. And we believe will likely be constrained for some time to come. Maybe we can focus more on the demand drivers just for a few minutes. You mentioned this idea of speculators versus end users. And so what do you have a sense of the percentage today where you are in terms of speculate? I don't know if you feel free to go, because you go granular, so you might want to comment on different markets.
So it's very hard to measure that, because the reality is, like, to know if an investor bought a home in January, we need to wait till like March or April for them to take possession. Then we need to wait another 4 to 6 months to see, did they rent it? Did they flip it? So we never have real-time data on investors. It's usually lagged by 6 to 9 months. But having said that, just in like on the ground, anecdotally, we're finding that the majority of people today are not investors, they're end users. We're seeing way more investors who are flipping today. So people who just bought homes 6 to 9 months, I don't want to call them investors. Maybe they bought intentionally to move into it or to renovate it, but they bought in June or they bought in September, and now they're listing it and selling it in January or February for like $200,000 to $300,000 more than they bought it, and they didn't do anything to it. And that's just, again, pure just dumb luck on their part that they bought during this rapid acceleration. I don't think I don't think that's going to continue. I think prices are too high to get those types of investors. So a lot of it, I think, is just going to be continued to driven by end users more than investors today.
Interesting. Okay, so there were kind of two things said there, right? So you're saying anecdotally what you're seeing is a lot of them you think are end users, which is actually healthier because they're more long-term. And I guess what you're also saying is that these end users have just lucked into, you know, a tax-free gain of 100 grand or more. And so they can sell their house. It's equivalent to earning 200 grand a year and just take the rest of the year off and not work and just collect their CERB. Okay. And I just wanted to focus on that because it matters when we talk about potential downside, right? Because to your point, I would assume that the speculators and the investors, you said you'd seen the data that that's where you had more downside, right?
Yeah, for sure.
Okay. So we'll come back to that because I do want to talk about area specifics. I think that's part of your huge value add. But one more demand driver, which would be interest rates. So I may as well ask you this. You know, it's kind of a biblical argument. I don't know if you read, you know, David Rosenberg or you know, the guy from The Big Short, Michael Burry, has been commenting on it. So Michael Burry's saying hyperinflation, you know, Rosenberg saying deflation. So it's like a biblical argument. People say that when you print so much money, you take on so much debt, you have to have inflation. But others say that if you take on a lot of debt today, you have to pay it back tomorrow, which means it's actually deflationary in the future because you have to reduce your spending in the future to pay it back. So realizing that if you knew the answer, you'd be on your yacht in the Bahamas during this phone call. Do you have an opinion on which way you think interest rates are going?
So, I mean, it's a tough question because, I mean, there's two parts to that. So the one part that is 100% true is that we're seeing an incredible inflation in asset prices, right? Which central banks don't care about. Like, it's not their problem. Like, you know, house prices could double overnight. They're not looking at that. So we're definitely seeing inflation in asset prices. Are we going to see inflation like traditional, like CPI? I honestly don't have a strong opinion. I mean, I also read a lot of what everybody says, and everyone makes great arguments. And I don't know which path we're going to take. I mean, certainly the markets seem to think that we're going to start seeing an uptick. And I probably would lean towards that a little bit. Like, I don't think it's going to be incredible, but I think we're more likely to see a little bit more inflation. I mean, especially as people, as COVID opens up, and I do think a lot of people just want to spend their money. And when you have that, we're probably going to see a little bit of an uptick, I would think, later in the year.
Okay. All right. Thanks. So by the way, I do see some questions coming in. If you do have questions, you can put them in either the Q&A or the chat, and we will try and get to them. I do want to carve out some time. I think John would be a valuable one to expose to everybody so that they can ask their own questions. So we're going to try and leave time for that. So I will get to them for those who are asking. Okay, let's get a little more micro now. So if we believe you, which I think we do, that prices are frothy and you got to be careful, which makes it hard for us because when we lend, we like to lend against a certain value. And so if we get an appraisal today that's 20 or 30% higher than it was a year ago, and we're lending at a 75% loan to value, that leaves you with very little cushion, right? So where do you think the frothiest areas of the market are?
So, I mean, definitely low-rise houses in the outer suburbs. So I would not say there's a lot of froth in the condominium market. Definitely not. There's not a lot of froth in downtown houses. I mean, they're appreciating at a good clip, but if downtown's going up something like 14, 15%, the suburbs are going up like 30, 35%. So definitely the frothiest segments are the outer burbs, like detached houses. Okay.
So I guess if you had a gun to your head and people were saying to you, you had to spend your money today, I presume then you would be focusing more on the less frothy areas like the condo market and I get houses in Toronto, or would you be just stepping on the sidelines right now?
Yeah, no, probably like low rise downtown. I mean, I'd be more optimistic. I mean, again, it's not as frothy. I mean, I'm more bullish kind of downtown in the next 5 years. Like, I don't believe this everyone's working from home narrative, downtown's dead. I mean, I think that's short. I mean, it's gonna come back. I mean, people are gonna realize it's not easy to work from home from Prince Edward County. So I do think longer term, I'm kind of more bullish downtown. So I'm looking at stuff downtown basically in the core.
Okay. And so we agree with you, by the way. We think that there's a bias called recency bias that humans tend to exhibit, which is you take your recent experience, you project it out indefinitely. And, as we don't have many people, but we've got 21 people, and we've noticed that for sure you miss out on stuff when everybody's working from home than when you're all in the office. And so at some point, all of that will come back. We were looking at trying to be opportunistic by buying condos where we thought, Airbnbs are sitting empty and they're going to be negative cash flow and there's going to be all this distressed selling. So we're going to go buy a portfolio of condos. And that didn't happen. And so maybe could you comment on what are the dynamics? Like what's happening in the condo market where you seem to have rents that have fallen, like the stuff that would support it fundamentally seems to be going down.
It's pretty wild.
It's been like they've been resilient, which we don't understand unless there's just too much liquidity out there and there's not enough pain yet.
So the condo story to me is super fascinating because what happened is, so rents plummeted in the downtown core about 20%. And largely because people were just moving out of their units, either, buying in, I don't know, wherever, like outside of the city or renting in a low rise house. So rents are down 20%. And then condo sales and prices softened in the downtown core. So condo prices sort of in central part of Toronto fell about 10% from their peak in Q1 of last year, right? But if you kind of look like peak COVID was kind of March, April, and then buyers started jumping back into the market, I'll say around June or July of last year, right? So starting June or July, the low-rise market was on fire, okay? Condo market downtown was a ghost town. I'm not even exaggerating. Agents would be happy to get 3 showings on a condo in their first week. And they're begging people to bring offers. Like stuff just wasn't moving. So it was super sluggish right up until October, November. And then all of a sudden it just lit up. And literally in December and in January and February, sales were up 70, 80% year over year. All that inventory that was sitting on the market just got absorbed. Everyone just rushed back in. And I think what's happening, or what we see is happening on the ground, is that and this is what's interesting about housing markets. I mean, a lot of it is behavioral, right? Like something clicked in November that made people feel very optimistic. And I do think a lot of it was probably a lot of the news back then about the vaccine rollout. And it left investors feeling confident. I mean, rates are so low, they want to park their money somewhere. Condos are cheaper than houses. They saw prices dip 10% and they said, you know what, I'm going to buy the dip. So they rushed back into the market. Now all of the inventory, it's super tight downtown. Prices are rising slightly, but you are correct that it's a very interesting phenomenon because the math doesn't, again, like investors are buying $600,000 condos and they're making $1,600 a month in rent, right? So that's not that great, you know, when you factor in your maintenance fees and all these expenses, but they're doing it largely because they're just optimistic that this COVID thing, this rent decline is short term. And, you know, in the next 12 months, rents are going to pick up and prices are going to pick up, right? And there's a ton of money and people are just needing to find somewhere to put it. And right now it's downtown condos. And I think in the short term, this is like the next segment of the market that's just probably just going to light up. And I think a lot of it is just investors wanting to park their money somewhere.
Okay. So if you're a momentum trader and a speculator, maybe condos are not a bad place to be. But if you're a fundamental investor, because we spent a lot of time on this. Mm-hmm. And, you know, we naively thought, hey, you know, we're going to go pick up condos. We're going to buy portfolios at $800 a foot, you know, $750 a foot, which in some submarkets would be at or near replacement cost. Mm-hmm. But it didn't come close. Right. And so we debated, you know, should you be a buyer at 1,000 or 1,100 if you could get it there today? Mm-hmm. We concluded no. But I guess to your point, there could be some momentum there. But
yeah, there might be. I mean, to be frank with you, I mean, I'm not buying condos. I don't know. I'm not as, again, there's a lot of inventory in the pipeline. And while I think I'm bullish downtown long-term, I think the reality is, you know, I don't know if people are going to be rushing. I don't know if the return to sort of the rental market is going to be as swift as people think it is personally. Like, I think eventually it's going to rebound. So I think as an investor, you're just going to probably be stuck with these softer rents. You know, if you can handle it for another couple of years, then maybe. But I don't know, the numbers just, I mean, they don't look as great personally.
All right, so then let's morph two questions into one, because I was going to ask you, I mean, you triggered the question for me. I was like, okay, cool. So then, I mean, you said you like single family downtown, but, you know, if you have cash today, would you allocate it or would you wait because there could be a better opportunity in the future, which is really the question I wanted to ask, which is if we are in a bubble,
yeah,
how does it end? Like, how does it play out? Is it pop? Does it fizzle? You know,
yeah, that's a good question. I mean, I think, again, I think that what we're seeing today is quite unique. And I don't think we can, you know, history kind of, you know, rhymes. It rarely just completely repeats itself. And I think the big difference today is in a normal market, policymakers are really, really concerned when prices are going up 30% per year. And right now, they're not. You know, if you listened to Bank of Canada Governor Tip Macklем's speech last week and people asked him about the housing market, he basically said, yeah, we're seeing some irrational exuberance, we're keeping an eye on it, but basically they're not that worried about it. Like in their mind, this is just gonna fizzle out and it's no big deal, right? So, and on top of that, you know, they've been very clear that they got tons of tools at their disposal to keep the market going. Like at the end of the day, they kind of want prices to be going up. I mean, it's fueling a lot of spending. People can renovate their houses. They can landscape their backyard. They take out a HELOC, they refinance, you know, and I think they're leaning on housing to help pull us out of this recession. So I don't think they want prices to fall anytime soon. And I think that's what makes it interesting that if they do, there's so many things that they can do to just add a little bit more fuel to the fire. You know, all they have to do is just go back to, you know, the changes that they were planning on making to the stress test, which is basically just making it 200 basis points above, you know, basically what buyers are going to be paying. Now it's 300 basis points, right? So even that alone will add a lot of fuel to the demand. So I don't know how this unwinds. Like, again, because policymakers have this big incentive to keep it going, and they have a lot of tools to keep it going, right? So, and if it does, if we do see that it falls, the concerns that I have on the downside are that everything that's happened right now with COVID and this huge demand, a lot of it is low rates and policies have kind of pulled demand forward. So a lot of buyers who were maybe going to buy like in 2021 rushed into the market in Q3 2020, and people are going to buy next year are rushing in now because they're seeing. So eventually that demand shock wears out. And what does the market look like when the demand shock slows down and we have a little bit more inventory in the market? I don't know if prices fall again. It's too hard to say, but I think I'm not quite as bearish, at least in the short term, as I was like 4 years ago.
Right. One of the things we do, again, going back to simplicity, is that our AGM, we show the price appreciation chart, and you talk about, we believe in mean reversion. Yeah, right. So to your point, if prices should go up at 6 or 7% a year, because that's what they've done historically for single family house in Toronto. Yeah. When they're going up 30% a year, which is significantly higher than the mean, at some point it needs to come back to the mean, and it can do that by just dropping significantly. Yeah. It could do that by just stopping going up and just moving along in a straight line long enough for the average line to catch up, which frankly is not necessarily an unhealthy thing. I mean, the unhealthy thing would be is if it drops precipitously.
For sure, yeah.
And so I guess what I'm hearing from you is that there are at least enough factors underlying it that would hopefully mitigate the precipitous drop, at least as you stand today. That may change if prices go up another 20 or 30% in a year. But,
yeah, at least in the short term, right? I think like in the next it's hard to predict long term, but in the next 6 months towards the end of the year, like I can't, it's hard to see a scenario where prices plummet. Like we are so far into a seller's market. Literally half of the home buyers can just like get out of the market and disappear, and it's still a seller's market. Price rises would just not be going up 30%, they'd be going up 10% or 15%. So we're so far out of balance. It's very hard to imagine like what trigger would cause a decline, because you need a huge reversal to go from 30% growth to negative growth. And some might say, okay, that's what happened in 2017, which is true. Like literally in 2017, prices fell about 20% in 5 months. But it's a very unique situation. Like people say, okay, it was the land transfer tax. It wasn't the land transfer tax was like a catalyst. It was like a trigger that spooked everybody out because they saw how Vancouver's market reacted, which was negatively. So when the province said, okay, we're going to introduce this land transfer, or this foreign buyer tax, I should say, in April 2017, buyers started panicking. So right away, all the buyers pulled out of the market. Okay, we're going to see what happens. This isn't great. And all the sellers rushed into the market trying to time the peak. So you had this massive change in sort of the dynamics of the market literally in the span of 3 weeks. And the market just basically froze. So again, I don't know what would cause that today. That was a bit unique back then.
Right. I mean, thinking about what happened then and now, if you study the 08, some great books, like if you read Tim Geithner's book or Ben Bernanke's, you can see that, and it's kind of scary, but a lot of what underpins markets is, as you say, it's behavioral factors, right? It's confidence. And so when you look at what they were doing, what policymakers were doing when things went bad, is that they were focusing on things to bring confidence back to certain markets. And so I guess that's what you'd have to worry about now, is what could be a catalyst that could change.
Fear, fear and confidence. To me, that's like the biggest thing, right? I don't think it's like an economic thing that's going to cause prices to fall. Like even in 2017, it was fear. Like that's why, panic from buyers who pulled out, panic from sellers who rushed in. And I think that's the hard thing that makes the sort of this next, what happens 6 to 9 to 12 months from now, hard to predict, because it's probably, if it does slow down, it's just because, again, I think just the behavior of home buyers, their confidence, if things are sluggish a year from now, if they can't afford the house they bought, who knows, right? So yeah, it's going to be interesting.
Okay, and then just one more point on, because you said 2017 was a unique set of circumstances. policy-induced stuff that changed confidence.
Mhm.
And so I always like to compare and contrast. So today, I guess you're saying that the bias by policymakers would be to be supportive and accommodative as opposed to restrictive, just
Yeah,
given the
100%.
environment.
Yeah, I mean, and they've been pretty, like, Macklin's been quite clear about that. Like, they have no, the reality is they can't raise rates. Like, you know, they're kind of handcuffed. You know, they're like 5-year rates going up a little bit now, which might take a little bit heat out of the market. So, but you know, yeah, they have a strong bias to keep the market going, at least until we start getting out of this recession. And they've been pretty clear about that.
Right. Okay, so what I want to do is I have another question for you, but I'm just going to prime anybody. I would like to leave time for Q&A. And so if anybody wants to ask a question, you can do it, I guess, in the chat window or in the Q&A window. We'll try and get to as many as we can. But I've had this love-hate relationship with Twitter, okay? Because Twitter's like an echo chamber.
Yeah.
And so when it comes to politics, I'm seeing only the stuff that I want to see, but it's also the stuff that gets me all aggravated and angry. But on the other hand, I found it to be great because newspapers still editorialize by what they don't show as well.
Yeah.
Right. And so it is a good source of data.
Mm-hmm.
And I think you made comments about this as well. I saw it in one of your interviews. I think that Twitter is a good source of kind of data. So any advice on what we should be following or looking at, you know, on Twitter or you know, why you think it's such a good source?
Yeah, so I mean, I made a comment about that, like, I think literally last week, where I said, listen, the Bank of Canada and CMHC are now talking about exuberance in the market. And for anyone who's following Toronto real estate on Twitter knows that agents have been talking about this since October or November. Like, you know, and they may not have used the bubble word the way I did in December, but every agent on Twitter has been talking about getting 40 offers on houses, 50 offers, people flipping houses, making, you know, 20% in 6 months. Like all of these behaviors are all out there for people to see, right? So yeah, I do think you get a stronger sense of, like, again, if I'm one of these people who thinks like behaviors matter a lot, you know, people's what's going on the ground kind of gives you a very good indicator and sort of when the market's slowing down, when it's not. And sometimes the statistics can actually lag the market. So like when you, like a lot of times what we look for now is, you know, if you're worried about a market cooling down, you're just going to start to hear a lot of agents say, okay, we're not getting a lot of showings. We're not getting a lot of offers. A lot of offers are failing and sellers are relisting at a higher price. Like these are sort of like these early indicators of a market that's cooling way before they show up on any real estate board stats, right? So I do think if you're curious and you want to know really what's going on and sort of these early signs of momentum slowing down, they're all on Twitter.
Okay. And then from a selfish point of view, I'm going to ask, you know, for us, so we finance a lot of residential construction.
Yep.
Okay. Typically, you know, 60-ish% loan to value will go as high as 75.
Mm-hmm.
And be curious to know if you were in our shoes today,
mm-hmm.
right? Knowing what you know,
yeah.
and I guess now knowing what we do, how aggressive would you be? Because what we've seen in our market is that in the good old days, we could lend at 8.5% at a 65% loan to value.
Yeah.
The crazy thing is that we believe risk has actually gone up in the world, not down.
Mm-hmm.
But because there's so much liquidity in the market,
yeah,
to win the same loans, we would have to be at 7.5% and 75% loan to value. So we've got to take more risk by being higher LTV and getting less compensation for taking the risk.
Yeah.
So as a result of that, we're sitting on, you know, $20 million of cash. We've got a $45 million line of credit that's not utilized, and we're always asking the question, you know, are we being too safe? You know, should we be more aggressive? So if you were in our shoes, what would you do?
That's a great question. I mean, you know, so your horizons are probably what, like 12 to 18 months, I'm guessing?
Yeah. Yeah. Max 2 years. Yeah.
So again, I mean, I'm not as concerned about sort of the downtown core at all. Like if you're doing infill in the city of Toronto, I'd probably not concerned. I personally wouldn't be concerned in the next couple of years. You know, it's sort of these outer suburbs where you start to get a little bit more concerned, potentially like higher end properties. And again, those markets are segments that just might be more vulnerable in 12 to 18 months. I don't think they're vulnerable in 6 to 9 months, you know, but a year from now or 18 months from now, you know, a lot can change. And I don't know if prices would decline rapidly. My instinct is if there's a decline, it's gradual. I mean, Paul Krugman had this great quote where he talks about how, you know, bubbles deflate, and he said that they deflate with a hiss and not a pop, right? And his point was that, you know, we don't go from 30% up to 20% down. You know, we go from an incredibly hot market where houses are getting 50 offers to one where they're getting 40 or 30 and 20 and 10, and then one where, you know, houses are just sitting on the market for 30 days and there's only one offer, right? So like usually there's a long runway where you can kind of see these declines happening. So I don't know if we're there yet. So I probably wouldn't be as concerned right now. I think it's when you start to see the momentum slow down dramatically, like if that happens in the third quarter where houses are not getting bidding wars anymore, then that's kind of like, to me, you start maybe being more cautious.
Right. So would you use the sales to new listings ratio as a good arbiter?
I usually use like one called the months of inventory, because I find that it kind of really just tells you what's going on in the market. And it's great. I find it's great because it captures both the supply side and the demand. So, I mean, for those who aren't familiar, it's just basically, if you just look at the number of homes that are available on the market for sale at the end of the month, say it's 100 and 50 homes sold that month, well, you have 2 months of inventory, 100 divided by 50. Like that's just, you know, and generally a balanced market is anywhere from 3 to 4 months sort of in Toronto, right? Right now we have like under a month of inventory, which is an insanely competitive market. Anything that's like 6, 7 months of inventory is sluggish. That's where condos were in the downtown core last summer. That's where like the York region housing market was in 2017, like 6, 7, 8 months of inventory.
Okay. Just so you know, it'll be a sneak peek for you, but in our strategy session this morning, we were talking about how we can work more closely with you to get more sophisticated in the data that we're analyzing. Because I really do believe that, you know, if you have access to data, it'll inform smarter decisions. And, you know, that's what we need to do when we underwrite any loan.
Yeah, and I think the key is, I mean, it's good that you guys think about this. I mean, for me, the key is that you want to know what's going on in the markets that you're investing in, because, you know, you don't want to be looking at GTA stats. You don't want to be looking at Toronto stats, because things that are going on in Durham is completely different from what's going on in Peel, which is completely different from downtown Toronto. So I think it is important to kind of look at them separately.
Right, right. Okay, thanks. All right, so let's see if we can take a few minutes for questions. So I'm just checking in the chat window. So the first question is, what's the uber cool picture behind you? So it's not my painting. It's my wife actually created that, but so I can't take credit for that. But I'm working from home because for some reason my Wi-Fi is more reliable at home than it is at the office, and I didn't want to miss the call. So we've got a question from Selvi. It says, banks/lending institutions reaction to 35% increase in house price. So, I mean, how much do you speak to the banks? Do you have any comments on that?
Well, we don't speak. I mean, we hear from mortgage brokers a lot, and generally, like, there's zero concern. You know, the one concern, of course, was always, is a property going to appraise for what the person bought it for? But when prices are rising rapidly, and every 2-3 weeks people are paying more than what the same house sold for like a couple of weeks ago, you have no problem with appraisals, right? So generally, there's been no issues on the banking side.
Okay, I mean, I'll comment from our point of view. We always say that the appraisal is the weakest link in the chain, in the underwriting chain. And so we would be concerned if we saw rapid price appreciation, we would not want to be as high on the LTV. And I gave that example before. We would not want to be in a 75% loan to value loan on a property that was up 30% in 1 year, because we don't feel like there's enough margin of safety there. So we would dial back our risk appetite in that kind of environment. Okay, another question is, can I get a repeat of the session? By the way, John, they said it was excellent. And the answer is yeah, Ricky will be posting a video recording of this. So you will get a copy of it. Michael asked if you could comment on the future of the condo market, which I think we've addressed. So we'll move on. Okay, here's one from Daniel. What are your thoughts on the multi-res space in Ontario?
Yeah, so I mean, multi-res, I mean, I tend to like, and probably kind of what I would be looking more at rather than single family. I mean, again, especially if you want more than 5, 6 units, like just the reality is there's just like not a ton of inventory of that kind of product. And it's not often they hit the market and cap rates are low, but yeah, I mean, I'd be, I kind of tend to like it way more than buying a condominium for sure.
But would you be a buyer of multi-res in this market? Because that asset class has been extremely robust. As cap rates have compressed, as interest rates have gone down, the cap rates have compressed. I'll give you an example.
Yeah.
We bought some apartment buildings a few years ago with a partner,
Yeah.
and it was a value add strategy. So they went in there and they turned the units and made them modern. They did increase the NOIs, but on a building that was purchased, one of the buildings that we're looking at based on appraisals is up 50% or more in less than 2 years. Mm-hmm. So would you be a seller or would you be a holder?
No, I'd be holding. I'd be holding. And I do think I agree with you. I mean, to me, those are the best ones that you can probably get where, rents are below market and you can add value and you can turn over the tenants. I mean, those are 100% the best ones if you can find those types of properties. But yeah, I'd be holding downtown multi-res for sure.
Okay, great. Thanks. All right. Anybody else? Do you have any other questions for John? If you do, you can put it in the Q&A or the chat. Just give a second. John, are there any other comments you want to make? Questions I didn't ask you that I should have asked you?
I can't think of any. You had a lot of great ones today. Nothing else. I can't think of anything that jumps out.
It was fun. The time actually flew by. I really enjoyed this. Okay, so if there aren't any other questions, I'm going to turn it over to Ricky, who is going to take us home. John, thanks for this. I appreciate it.
Thank you.
Ricky?
Apologies, brief technical difficulty. I was expecting this in 5 minutes or so. So again, thank you so much for joining us, John. That was, I was so excited for this session and it just absolutely blew away my expectations. It's going to be very, very hard for us to find 3 more guests to top this, but we will do our best. So honestly, thank you on behalf of Face the Future. Thank you. I'd like to think that that having you as our guest was at least a large part in how much money we were able to raise today. So again, thank you. Thank you for everyone for joining us. We will release the recording in a couple days, and stay tuned for new news on future dates and future guests. Thanks, and be well.